Okay, can you hear my voice? Okay. Okay, let's start. Okay, today we have a tutorial number 5. I am not mistaken. Tutorial number 5. We will discuss about the exercise 2 from the ICM unit 6. Okay. So it's still. Okay. I will share my screen right now. I hope that you already download the screen, the files. Okay, so okay, as you can see here, this is the ICM number, is ICM unit 6, exercise number 2. In this exercise, we have 5 questions. Yeah, it's about the Black-Scholes option valuation. Let's see the question number 1. Question number 1 and question number 2 are the theoretical concept of Black-Scholes. Number 1 is how can the Black-Scholes models be used to establish the hedge ratio? Okay. Why is it difficult to maintain a properly hedged portfolio using option? It's already discussed in the exercise solution. Okay, we move to question number 3 and question number 4. Okay, it's a bit long for question number 3. Since we have limited time, which one do you want to discuss first? Question number 3 or question number 4? You have any idea, any option? Okay, first let's try to discuss the question number 3, okay? Question number 3, we have information about an option. Question number 3. Again, I want to make it large. Okay, we have the stock price is 90 pence. The exercise price is 80 pence. The volatility or the risk of this option is 0.4. The T, time to expiration, is 75% or 0.75, and also the risk-free rate is 12% or 0.12. So to calculate the call valuation, the formula is provided here, yeah, as in the presentations files from Dr. Betty, and the formula to calculate D1. To calculate D1. D1, yeah. And also how to calculate D2. Okay. Question A, use the Black-Scholes option pricing to value a call option on a share with the information as specified above. So we need to calculate the pricing models of the value of the Black's option with the information here. So okay, using this formula, we calculate first D1 and then D2, and then we calculate the call option pricing based on Black-Scholes models. So first, insert the value of D1. So insert the value of 1, learn the stock price is 90 divided by the exercise price is 80 pence, plus the risk-free is 12%, plus a square of the volatility, 0.4, and divided by 2 times the expiration, or 0.75. This then we divide it with the volatility multiply by the square root of time to expiration. Yeah. So we have the value of D1 is 0.1178 plus 0.15 divided by the 0.3646 equals 0.7730. The next is to calculate the D2 based on this formula. Yeah, we calculate D2 using the formula. We get 0.7730 minus this one, the value of volatility times the square root of times expiration, 0.3646. So the value of D2 is 0.4266. Yeah. Next is to calculate the ND1 and also ND2. So as you know, the ND1 and also ND2 . So what's the meaning of ND1? It is the normal distribution of the value of D1. So we can use a calculator or Excel files to calculate this. I'll show you the Excel files. Yeah. Okay. So using the Excels, here is the data. The stock price 90. The exercise price is 80 pence. Volatility 0.4. Risk-free return is 0 minus 12. Dividend is 0. Days to expiration is not there. Time to expiration is 0.75. So the D1, we can calculate the D1. Yes, based on this, based on the formula of D1, 0.7730, and value of D2 0.4266. So the value of ND1 using this formula, norm dot distribution, yeah, we insert the value of X is 80, mean 0, equals 0, standard deviation is 1, the cumulative is true, so we will get the value of ND1 0.78 T24 and so on, and also the value of ND2 using the same formula. Using the formula, we got 0.6651, right? So we got here 0.7802, while for ND2 0.6652 or 51. Okay. Now we want to calculate the call option value. Using this formula, we insert the value based on this calculation, we calculate the E square minus RT we get 0.9139. Okay, for the value, the options okay. 90 is the value of the stocks. ND1 is this one minus exercise price, value of E times the value of this multiplied by the value of ND2, 0.6652 here. And then we got the value of this option using the Black-Scholes model is 21.59 pence. Yeah. Okay, that's the answer for the question 3A. Question B. What would be the value of an European put option on the same share with the same price and expiry date as for the call? So basically, we are using the formula of put on call parity here. Yeah, the stock price plus put option is equals this value plus the call option. So we just insert the value of this and therefore we get we got 80 multiplied by 0.9139 plus 21, yes, this value 21.59. So this is equal 4.70 pence. Yeah. Okay, that's for the question 3B. For the question 3C, an investor owns 1,500 shares. What action should she take to hedge holding calls using call option? Okay, so she want to hedge her holding using call option. And then how many options would be required and what would be the total value? So for this question, since it is she needs to write how many calls. So this action, she needs to write 1,500 shares or 1,500 shares divided by the value of ND1. Yeah. Therefore, you need to write the value of ND1 is 0.7803. So we calculate this one, 1,500. So we got 1,922 calls. How many options would be required? She needs 1,922 calls. So what would be the total value of this option? So the number of the value of this option equals the number of calls times C. Yeah. So sorry, the percentage of C is 159. Therefore, the value of this value of this option would be 414.96. Yeah. Okay, question D is in contrast to the question C. Assuming the investor were to hedge her holding using put option, yeah. This is question C. And question D. How many put option would be required and what would be the total value of this option? So first she need to buy number of shares 1,500 divided by 1 minus ND1. So this is 0.217 equals 7 puts. Okay, move to what is the value of this put option. So the put option, you have symmetrical, the cost of the put option would be the number of the put 6,827. Let's multiply by this. Yeah. So we got in pound sterling 320 pound point 87. Yeah. Okay, well, you got it. Okay, question E and F. Question E, assume the share price. Okay, it could be long. Assume the share price change. Today, assume no change in time to expire to the share price change to 85. So this is lower than the current price. The stock price is 90 and it changed to 85 pence. How much will the investor gain or loss if she hedge using first, if using call? Okay. So because the value of the price of the stock has changed, we need to calculate again the D1, ND1, and also the D2 and also ND2. Yeah, as you can see, the D1 is learn 85 because the new stock price is 85. Yeah, the rest is the same. So we got the value of D1 is 0.6086. Yeah, and the value of ND1 using the normal distribution as in the Excel files. Yeah, so we got the value of ND1 is 0.728. And as for the D2, equals D1 minus the volatility multiplied by the square root of the times to expiration. We got the value of D2 is 0.2616. Then again, we calculate the ND2, the normal distribution of D2 equals 0.6031. After that, we calculate again the call price. C, we got 17.82. And the put option price, yeah, using this formula. Yeah, using this formula. Okay. Okay, we have 5.93 pence. Okay. So what if we want to hedge using the call option? It's similar with the previous equation. $5,000 now stocks share. multiplied at 0.9 50 cash from calls cash from calls $404 414.96 plus MV of call return minus 414.96. Therefore, the net wealth is still the same. So the new wealth is in stocks 0.85 75 cash from call return for 26. The less MV of calls is minus 342. So we got this value from the number of calls here, 1922 multiplied by the call price 17.82 pence or 0.1782 pounds sterling, and the net wealth is $1,347.46. So since the net wealth is less than the original net wealth, our loss is 1,350 minus 1,347.46. This is 2.54. Yeah. She lost because the new price is less than the current stock price. Okay, for the hedging using the put option, I just try to copy the result and explain it. 1,500 shares multiplied by the stock price 90 pence or 0.90 is 1,350. So the cash value for the puts minus 320. This one, yeah. And value of puts held, yeah, equals to the cash paid for put. So the net worth is still the same, 1,350 pound. The new wealth with the new price of the stocks, 1,500 multiplied by the price of the stocks, so 1,275. Cost of puts loans, yeah, similar, minus 320.87. The value of the puts, the value of the puts. This is the number of the puts, yeah. The number of the puts multiplied by the value of the put, yeah, 5.93 pence or 0.0593 equals 404.84. So the net wealth is 1,358.97. So the total wealth, okay, equal 0.97 minus this one, 1,350. So equals 8.97. Okay, so that's the discussion about on question number 3, and you can have try to understand the question number 4 and question number 5. Yeah. Okay, so some of you asked for my email. We'll put my email if you have any question regarding this exercise or also the quiz. Yeah, you can send the email suggested by Betty, and then after this you can join Dr. Betty's session. So I'll put my email here. Chat section. So this is my email. Okay. And then I invite you to join Dr. Betty's session. I think that it should be started right now. As usual. Yeah. Okay, thank you very much for attending this session. Thank you again. Have a nice day. See you again. Bye-bye.
Here to show his face. Hey, hi. Finally. Hello. One more person. That's very lovely. Okay, now we have 28. More like it. I think that's probably it. Okay, so should I? I don't think I want to repeat what I just said. Okay, that's fine. I'll just make a start. Okay. So hello everyone. For the latecomers, I guess that just in your GTA last session, you spend more time, but that's fine. Okay. I haven't really started my review session yet, so don't worry. You didn't miss much. Okay. All right. So I think that's probably it. Okay, let me share my screen. Oh, by the way, so for the latecomers, you do know that we're going to have a revision session, right? If you haven't attended the Q&A session, probably you don't know it yet. We're going to have, so this is really the last teaching week. And also this is the last tutorial session. And so next week, there will be just revision, nothing. And we're going to have a revision session on Friday. So from 1 to 3. Okay, so just be ensure that you are there. And the first week, not the first week, the first hour, will be a course review. So, hi, Wiku. Hi, Wiku. Did you see me?
Hi.
Hi. Okay, that's good. Okay, so the first hour will be a course review. So Ufu will start for 50 minutes, 10 to 15 minutes, covering his part. And then I'll take over, spending 30, 35 minutes to cover my part. Again, one question coming from his part, 2 questions coming from my part. And for my part, again, 1 question on bonds, 1 question, the other question on derivatives. And the questions on derivatives will have small questions on global investing. So every topics will be covered. Okay. And also for 3 questions, each question accounts for 33.333%. So it's all 3 questions are equally weighted. Okay. Again, we would really like to have some kind of diversified approach. We're talking about investments, we're talking about diversification, so we should do it as well. Okay. All right, and so do you see my slides? Fine, right? Great. Okay, let me get rid of this. Okay, let's get started. So this review is on 6.2, and in my part of review session, I will talk about Unit 7 as well. Okay, so we are not going to have a proper review session on Unit 7, but in my review session, I will talk about it. I think that if you already seen it, you know that Unit 7 is small. It's a really small session, okay, talking about global investing. And any questions on global investing will be, I wouldn't say essay type, but it would be no calculations. It's about discussions, okay, on things in there. Okay, so this unit is on option pricing. So it's a continuation of the unit 6.1, the basics, fundamentals options, and then we'll talk about more advanced topics. More specifically, we'll be talking about pricing models and also talk about option portfolio management. So specifically, it's about option valuation model, 2 models. So I would say, this is really not new because we talk about Poco parity. This is also a kind of option pricing model, but it is a relative statement of the prices of the calls or puts, something else. And in terms of the absolute statement, then we'll be talking about binomial option pricing model and the Black-Scholes valuation model. And you need to know what they are, the main difference between them, and maybe some problems, pros and cons of each model. So in simple terms, binomial option pricing model assumes that time is a discrete time. Okay, so time periods would be 1, 2, 3, you can count them. Okay. And in terms of how prices move, like binomial option pricing model assumes that the price is a very simple way, only two states. Either price moves upward or the price moves downward. So up or down, okay, by how much percentage. On the other hand, the Black-Scholes model says the time is a continuous time. So it's not 1, 2, 3, 4, 5, but it's just it flows continuously. So if you remember, if you're using discount factor, it will be e to the power minus RT, rather than using 1 over 1 plus R to the power R, T. Okay, so it just works in different ways. Okay, and also in terms of how prices move, the Black-Scholes assumes that it's not going up or down, but it follows some kind of distribution. The price move in some kind of statistical way. Okay, and the good thing about Black-Scholes is that it provides a closed form solution to the put and also call. It means that you can calculate them rather easily. Plug in the numbers and then you can calculate the put or call values. But for binomial option pricing model, there's no closed form. It's open form. That means you just have to calculate. And the calculation can go very, very complex. Okay? And so in terms of exam, we're not going to test you, numerical elements about the binomial option pricing model because it just takes time. And I don't think that exam should test your ability to calculate. It should test your ability to understand stuff. So we're not going to test your calculations on binomial option pricing model, but we're going to test your calculations on Black-Scholes because it's easier, it's more straightforward to calculate. Okay, and also it's it's a very common model. So the model to go to start with when it comes to option pricing. Okay. And the second element here is option trading strategies. Basically you need to draw and you will draw. So you just ensure that you draw nicely, okay? If you're going to draw, by hand, please ensure that you draw in a nice way. Don't just randomly draw. It makes things very, very bad. So draw. And you draw and you compare, and then you discuss and you compare, contrast, and find the break-even prices and all those sort of things. And there's one small thing, other option applications, and that's in the self-study slides. Okay. And there are more different suggested ratings in here. 2 are essential, 2 are recommended, and they are all about Black-Scholes. So again, the Black-Scholes is super, super important in this unit. And these 2, the Black-Scholes model gives the authors the Nobel Prize. So you can imagine how important that model really is. And in terms of exam preparation, I don't think that you need to know the theoretical or mathematical elements. It's just it's way out of what the ICM is all about. I think the ICM is about application. It's more about how to do things, why, rather than the theoretical background. I think that if you're interested in the theoretical, feel free. And also we have more advanced courses in the second semester, so that if you're interested, you can choose them. I'm sure that you have derivative securities courses in the second semester. So if you're interested, you can select them. Although this is a short piece of article, how we came up with option formula, I think it's quite nice. It gives you the story behind this model. When they first come up with this model, it's not really very well received. Although it becomes super, super important later on, there is some drama, not really drama, but there's some story behind. So I think that it would be nice if you can have a look at what the story behind. All right. So let me get to the topic in here. So before we talk about the two option pricing models, I thought it makes sense to recap the Poco parity. Okay, still, this is the option pricing model. But again, I already mentioned that it makes relative rather than absolute statements because put call, they're all they depend on each other. So that's what we mean by they make relative statements. Okay. And with this Poco parity, this allows us to construct a put protected stock portfolio. Okay. So protected from downside risk, but in the meantime, enjoy upside potential. And then, so the option pricing model, I think the fundamentals, so we need to talk about the fundamentals. So to understand this, probably, you can think about, there are so many reasons why people want to hold options. But to understand the pricing, probably the best way to understand the option as a risk reduction tools or use them as a hedge rather than use them as a leverage, but as a hedge to protect your position. So let me give you, going back to this. So again, remember, when we come up with Poco parity, the idea behind this is to construct a hedged position. Okay, it means that your net position is the same regardless of future price movements. So indeed, the idea behind this Poco parity is coming out, consider options as a hedge. We're trying to achieve this hedging position. And that principle applies to the two option pricing models we're going to see, okay? And also here, you need to forecast the volatility of future prices. So you need to have some idea of the volatility or how price might move in the future. Okay, remember binomial, you need to know, whether how much price move up or down by how much in the future. And for Black-Scholes, you need to have some kind of idea of how price moves in a statistical way, right? But interestingly, here, you don't really see such prediction. Here, you don't need to know the volatility of the prices. Okay, so in some sense, this sets a Poco parity apart from the two pricing models we're going to see. And hedge ratio, this concept is also very, very important here, and it's used in both models, binomial and also Black-Scholes. They use this hedge ratio to achieve the hedged position. Okay? And the hedge ratio is based on the range of possible option outcomes related to the range of possible stock outcomes. More specifically, it captures the sensitivity of option price change or options and with respect to the underlying price change, okay? And in the end, this is what you're trying to achieve, the risk-free hedge. And how would you do that? You buy one share, I'm doing very badly, but buy one share of stock and sell calls to neutralize risk. So again, to achieve the hedge position, you long a stock and then you write a call. So that, when price goes up, the profit of the long stock position will be offset by the loss of the call position. Remember, you're trying to achieve a hedge position. You don't want your position to go up or down in the next period. So that's why you write a call. Because it's a hedge position, then we assume they should go at a risk-free rate. So this is how we come up with the pricing in the end. So it looks very ugly. Disgusting. All right, so this is a very typical model of binomial model forecast trees. So in the lecture notes, it starts with a very simple two-stage, two-period option pricing model. So we say two states, up or down, two period, only today and the next period. So that's the example you see in the lecture notes, okay? And still the exercise, following 3 steps. So estimate the number of call options that you need to write and determine the present value of the portfolio. In the end, you can calculate the price of the call option. Okay, following the 3 steps, usually you start from here and getting back, backward induction, and then you can get this call. Okay, that's fine. And then you can expand this simple model into a more generalized model. Okay, so now before we have 2 periods, and then you can have many periods, and the more periods you have, the more precise your estimate will be. But the calculations involved will become very time consuming or very tricky. So there's pros and cons of this modeling. Okay. But don't worry, you're not going to be tested on that in the exam. Okay, calculations, no worries about that. And for let me see, fine. This is Black-Scholes. Okay, and in the past, you're sitting in the exam, you'll be given a formula sheet with all these different formulas. You have D1, D2, all this formula or Black-Scholes core value. And probably you calculate D1, D2 individually. And first of all, you should calculate D1. And then with the D1, you calculate D2, and then use the standard normal distribution table. Then you're going to find n of D1, n of D2, and then use S. By the way, so this is continuous time. So with all these numbers, you calculate C. And probably they'll take about 5 minutes, 10 minutes or so. This year, please don't. Okay, you should use your own software, you should use your own spreadsheets. And wait a second, do I have that somewhere? So this is somewhere, example, option, slides, this example. So one example I can give you is, let's share my screen. So I think I probably showed this to you in my previous session, but just to remind you, okay? So for instance, you can come up with your own version. And so C, this is a whole formula, right? And D1, D2, can calculate this following the formula. I would prepare this. I think that it makes sense. And to be honest, I accidentally uploaded this on Moodle, so it's already there. Maybe you already know that. But if you don't, actually you can find that there. The good thing about this is just change your parameters and the results to show up immediately. Okay, I think it makes sense. It makes sense to do this. This is the open book. And also because we know that you would do this. In the past, for a call, probably will give you 10 points. Now, at most 5, at most 5. Typically, probably 3 points or 4 for a call. So usually we'll ask you more based on this information you calculate. So what I'm trying to say is that because for a call, if you're going to receive 3 or 4 points, you shouldn't really spend 10 minutes calculating call. So I'm just saying probably you should come up with your own version to calculate these numbers. Okay, 0.2. You can the numbers are changing instantly. Okay. All right, back in here. Fine. All right. So the Black-Scholes valuation model is a model for determining the value of European style. So it means that the options that can be exercised only on maturity date. You couldn't exercise early, okay? If for American style options that allow for early exercise, you shouldn't use Black-Scholes or you shouldn't use this model, okay? And this model, assuming that prices can change continuously, so that's why you're using this. This assumes that the time is continuous. And assumes that price movements can be described by a statistical process known as a geometric Brownian motion. You don't need to know what's behind this. You just need to know that the price is not like this. follow some kind of statistical process. Okay, there's some kind of distribution there. And also very important here is about hedge ratio. So it's really about hedge ratio, delta. Okay, that we already mentioned here, delta, right? Hedge ratio, delta. So this captures a change in call option value given a 1 unit change in share price. And if you do, get away, how can I get rid of it? Or I can write it here. C S. Okay, the first differential. So if you do the first differential of C with respect to S, then you will get this. This will be gone. Okay, it's just calculus, simple calculus. And so to hedge one share, you need to write this number of calls. This is a reciprocal of this one. So you can offset the impact of price appreciation. So you need to write this number of calls. And for put option, you do similar ways, but you need to buy this number of puts to hedge one share. Okay. And you in the lecture notes, you do have examples trying to walk you through these concepts. So just ensure that you read them. By the way, there are 2 ways to calculate put options. First, going back to my example here. So yes, great. So you can calculate put options directly using the formula, similar Black-Scholes formula, or you can use the put call parity. So once you have the call, then you can utilize put call parity to help you get the put option. So there are 2 ways. And obviously you can see in here, I put 2 in here, just to double check. Okay. Okay. All right. So now you see that the call depends on S, depends on end of D1, D1 behind. There are some variables. So it's exercise price, time to expiration, other things. So there are some variables, I wouldn't say hidden, but behind D1 and exercise price. So these variables affect call options value and also put option value. And usually they will have sort of opposite impact on them, except for really this one, security volatility. So price movements are really, really good for options. So, greater volatility, more valuable an option is. And the reason behind is really, when prices become very volatile, it's more likely that the price will move in the way that you like. If you expect the price to go up, if price become very, very volatile, it's more likely that indeed the price will move in the direction you want, and so that you can exercise your options, and then you can just make a profit out of it. Okay? So volatility is good for both options. And that will have some implications later on in our discussion in the applications. All right, so here, Black-Scholes values. So this is about a call. Oh, that's fine. I think I can use this as well. So the exercise price is 40. And, when I draw intrinsic value, I always like to start with the exercise price, because this is when, the break-even price, okay? So when the stop price is equal to 40, that means if I exercise it, then I'll buy at 40, sell at 40, so it's 0, right? Intrinsic value is the value if I exercise it right now, so it's 0. I can exercise, I don't need to, I'm indifferent. And so when the stock price is higher, that means I can buy low and sell high, then I start to make a profit. And so you can see that this line, I think I'm trying to maintain my, okay, I'm doing okay. You can see that this is a 45-degree line. Write a call, but no one buy. Yes, yes. Again, if you have a transaction, that means you need to have both sides. If you write no one buys, then no one buys, right? So no one buys, no one exercises. So it's just that it's not a transaction. The hedge is not working. That is true. Yes. So basically, the hedge means that there's a transaction. So if there's no buyer, then that's not a hedging. So yes, it's okay. Efficient market. I'm not sure what you mean by efficient market. Oh, that's you. Okay. What do you mean by efficient market? You mean the theory? Oh, are you saying that we always assume that there is a buyer? Yeah, that's fine. So assume that there's always a buyer. It's an efficient market. That's fine. Okay, now I get it. Great. Okay, it's never too late. You're welcome. And so this is intrinsic value, and if the stop price is lower than the exercise price, then it's better if you don't exercise it. If you exercise it, you are making a loss. Okay, the line will go down. So you're better off not exercising. So it should be here. And we see that the Black-Scholes value will be always above in here. And here we assume the option price, or this is the right price. So this is equal to option premium. Right, very, very slow. This is really bad, but price. It's really bad. I should have used a pen, but you get what I'm trying to say. So this is option price. We assume that is the right value, so it's the price. So you see that there's a gap, right? So what does this gap capture? Anyone? Premium, excellent. But it's not a perfect answer, okay? Because it's called time premium. Almost there. Because a premium, yes, there's a time. So if you give me a premium, I couldn't give you full marks. You need to give me time premium, I'm afraid. The premium can mean a lot of different things, right? So time premium or speculative value. Okay, but basically it captures the difference between option price or option premium and the intrinsic value. And here, I put a line here. It's supposed to be crossing 20. So this line represents the value of the stock or underlying. So if the underlying is 20, that means that the value is 20. This represents the underlying, okay? And my point is that option value should be between the underlying value and the intrinsic value. That's my main point. It means that the value option should not go beyond the underlying value. It doesn't make sense. Right? It's a derivative. Okay? So it's really the underlying value to be the upper bound. And on the other hand, the intrinsic value is really the lower bound. So it wouldn't go below. Otherwise, the time premium will be negative. It doesn't make sense. The benefit of waiting should be at least 0. It shouldn't go negative. Okay, that means if you're waiting and you'll be penalized, then you wouldn't wait. You just exercise right now. Okay, so the time premium should be really kept at 0. All right. So one thing I'd like to mention is that the slope of the tangent line of this curve captures the delta, because you can see that the slope is the change in the option value divided by the change in stock value. And that is the exact very definition of delta, okay? And then there are 2 applications using a delta concept. So the first one is called dynamic or delta hedging, and the other one is called delta neutral. It's really just to utilize the concept of delta coming from Black-Scholes and see how can we use such concept. So the first one is in the lecture notes. Suppose a portfolio currently valued at 100 and at the money put option on the portfolio might have a hedge ratio or delta, okay, of minus 0.6. So remember we said that delta of a call option is like the slope. And you can see from here it's always positive. Okay, and for the put option, it's the other way around. It's always negative. Because if you draw a similar line, you'll see that the value gets higher when the stop price gets gets lower, declines. So you can see that it becomes more valuable when put option becomes more valuable when the stop price drops, and so the slope is actually negative. Okay, we'll see a graph. You'll see a graph in here. This is about a put, and you see that it's always a negative slope. Okay. And so here, suppose the stock portfolio falls in value by 2%. The profit on hypothetical protected put, if it exists, would be as follows. And actually, it's from the lecture notes. I'm not going to talk about the details, but it's just that assuming that a protected or a put option doesn't exist. Protected put means that you're going to buy a put option to protect your current stock. A long stop position. So assuming that such put option doesn't exist, what can you do? Then you can create a synthetic option position by utilizing the concept of hedge ratio. So how would you do that? You can sell a proportion of shares equal to the put option's delta. And you see that this is minus 0.6. So selling 60% of the shares. So what's left is 40% of the shares. And then you use the proceeds from selling 60% of the shares to buy the same amount of risk-free assets. And by rebalancing, changing your position, then you can achieve exactly the same protected put position. Okay, so it's just one way. It's not the only way. Again, here we're talking about one way. When it comes to options, there's so many different applications. And this just to show you one example, how can you use the concept of hedge ratio to achieve synthetic protected put. And so here, the slope of a tangent line, again, delta hedge ratio. And the challenge with this procedure is that deltas change or constantly change. As you can imagine, when price changes, deltas changes as well. So the market declines require extra hedging. Remember, if the stock price drops, you have to hedge, you have to sell. And then when you sell, price changes, and then you have to hedge. If the price drops again, you have to sell more. So you can see that probably if the price continues to drop, you just continue to not just rebalance your portfolio, but you have to keep selling. If everybody keeps selling, you can imagine that the huge selling pressure on the price, and that might lead to a crash if everybody's selling, if everybody's doing this delta hedging. Okay, so but the idea is that this constant update of the hedge ratio is called dynamic or delta hedging. You just need to keep rebalancing, keep hedging, because deltas change constantly with price change. Okay. And the second application is this. So hedging on mispriced options. I would like to, I couldn't really see. I still like highlighter. I can see better. Okay. So option value is positively related to volatility. We already talked about that. Volatility is good for option values. Okay. But before when we talk about volatility, we actually talk about, obviously, when we talk about volatility, sometimes we talk about realized volatility. You use past data to calculate realized volatility. And here, when it comes to option value, or when we talk about Black-Scholes, it's about implied volatility, or the volatility that we expect it to happen in the future, the forecasting the volatility. And so we have this term, implied volatility. it means that this volatility measure is implied from Black-Scholes models. So remember, if I go back to here, how do we calculate call? We have some estimate. No, we know the price. We have some estimate about the price, the sigma, the volatility. And also we have information about exercise price, we have everything. So when we have everything, we can come up with a call. Implied volatility works the other way around. Assuming I already have a call value, and with other variables already known, you can estimate the sigma. Okay, and that sigma is called implied because that's implied from the model. Okay, and so if an investor believes implied volatility in an options price is too low, then you believe that the volatility will go up later on, so that you believe that the current price of the option is too low, undervalued. There's some mispricing over there. And so you believe that makes a profitable trade possible. Okay, so a profitable trade is possible to take advantage of mispricing. In this case, you should buy, and later on the price adjusts, and then you can sell at a higher price. Okay, but profit must be hedged against a decline. But again, this is about hedging. So a profit must be hedged against a decline in the value of stock. So in the sense that if you know, in this case, I think in this case, it's about a put option. Okay, again, this is from the lecture slides. So in this example, it's believed that the put option is undervalued. So what you can do is that just say you buy the put, and then hoping that in the next period or later on, or even when the price doesn't change later on, you will make the profit of this price adjustments. That's fine. But the problem is, if the price actually goes up later on, then you are making a loss because price going up is not good for your put option. Okay, so how would you protect yourself on that? You buy some stocks, and this number is actually from the hedge ratio. Okay, it's behind this. So you can see that in the next period, the stock price, let's just say there are 3 different scenarios. So the price stays the same, you're still making a profit because of mispricing. How the price is calculated. I think that in this case, the put price is given. Maybe it's given in this exercise. Okay, and if it's not given, I think it's given. I think in this exercise is given. Okay. All right, and when the price, what's going to happen by the trade? If only want to trade options, not stocks. I think that in this case, investor can only trade options, that's fine. But the idea behind this exercise is trying to achieve a hedged position. And that's why they hold stocks. But if you don't, if you're not interested in having the hedge position, then you can obviously just buy the put options. That's perfectly fine. But you need to be aware that you might make a loss if the price goes the opposite way. If the price goes up, then actually you'll make a loss. And that is why, by having shares, you can ensure that you are hedged, you are not making a loss. But it depends on, what you want, your motivation, your belief. Okay, I think that's in general very important in options. In option questions, I always ask you why. This option is what's the belief? What's the belief behind? What's the motivation? Why people might want to do this? And you compare different strategies. This is for what? Is this for volatility? It is for bull concept. You have a belief that the market is a bull market or a bearish market. Are you conservative or are you risk taking? All different concepts. So I think it really depends, and really should know that. Do I have another question? Can I couldn't really see the box. I'm going to answer that later on. That's fine. Okay, so you see that when the price goes up, then actually making a loss. So holding equity can actually protect or offset that loss, because when price goes up, you make a profit coming from your equity, long equity position. And from here, you know that although you are making profit from the value appreciation coming from the put, you are making a loss in terms of equity position, but that's fine, because ideally you want to maintain this hedge position. So again, remember, this is not really, obviously you want to make, take advantage of the mispricing, but more important, you want to hedge. So by doing this, you can ensure that your position is hedged, or making a little bit profit if the price changes. And the main takeaway is this: delta neutral, which means that your position is hedged. Option hedges might eliminate exposure fluctuation in the value of underlying assets. They do not eliminate volatility risk. So remember, here it's assumed that volatility doesn't change. It's a fixed number, but volatility can change. Okay, I think that's probably one main drawback for the Black-Scholes. Okay? Black-Scholes assumes that volatility is constant. There's no change in volatility, but in reality, volatility can change. Okay, and by doing this, you couldn't eliminate that. And one example is that even if the price doesn't change, when volatility changes, that will have an impact on call values or put out values. Okay, volatility really matters in here. All right, so this is the last slide. Am I going very over time? But I'm hoping that this is helpful. Are you still with me? Are you still with me? Am I talking too much? Are you still with me? Okay, great. Any other people? Thumbs up? Yes, great. I have a lot of yeses. Love to see yeses. Okay, so the last thing, option trading is always good to extra time. I'm not sure. Sometimes I feel like I'm talking too much. Again, to be honest, I'm not a very talkative person. If you see my response in my email, I always have a very short response. But I'm really hoping that this is helpful. Okay, I'm trying to make this helpful. Like we can have some people. We'll see the revision. We have revision, right? We have revision session. That's for your exam. All right. So option trading strategies. So we have two different categories with equity positions, without equity positions. It means that whether you want to have options together with some kind of equity buying, like what we just saw before, right? It's a combination of holding long put and long stock. And this is similar. So this is when you consider buying an option, stock, I'm sorry. And that's why it's like this. You need to take into account the purchasing price. In this case, is 40. Otherwise, it would be like this. Okay, so be careful, when we say long stock, is it like this or is it like this? It depends on what the question is asking. If the question says, consider buying a stock, then it should be like this, because you haven't bought it yet. So you have to consider the purchasing price. If that you already have a stock, if you already have a share, then it should be upward. It doesn't, don't need to just assume that the price is already long time ago. Okay, so just be careful. And you can short a call. And if you short a call, you receive a price, right? And then the shorter call is not very good if the price goes up. Not the price, the stock price goes up. So the combination of these two is like this. So it's called covered call position. So to be profitable, the covered call strategy requires the investor guesses correctly. So again, something like betting or some ideas, some belief correctly that the share prices remain reasonably close. So it's reasonably close to the current level. If the price drops, that's bad, but it's better than long stock because you receive this amount. So actually you get additional, give you some buffer. The really bad thing is about here. If the price actually goes significantly higher, then you're worse off compared to a long stock position, right? Originally, if the price goes up, you can enjoy some upside potential, but because of writing this call, your upside potential is capped. Okay, so it really depends on your belief. There's some noise. Okay. And without equity precision, so I can show this. So there's a long straddle, short straddle. They both refer to this option combinations of call and put options on the same underlying security with the same exercise price and expiration date. So you can see from this, you can guess that the exercise price is 40, 40, 40. The same exercise price, and that's why you have a tipping point. Okay. And if both options have different exercise prices, then you wouldn't see a tipping point. You will see the flat bottom. And in this case, it's 35 or 45. And both options are out of money options. What's the benefit of having out of money options? Anyone?
Okay, so you pay like less premium?
Yes, cheaper. Great. You're getting it. Very good. They're cheaper. Okay, out of money, intrinsic value is 0. They tend to be just capturing the time premium cheaper. Okay, so that's good. Cheaper is good, but something has to give. You know that, right? So what's then comparing to long straddle cheaper, but the volatility, oh, by the way, so this is a volatility play. It means that for long straddle, they really want the price movements to be very, very big. Either direction is fine, but they need to be, the prices need to be very volatile. And for short straddle, they want the price to be stable, relatively stable. The best scenario is that it doesn't move at all. So you do see that both sides have the opposite beliefs. And just depends on which one is correct. Okay. But for this one, for long strangle, the movements needs to be even bigger, so that they can start making a profit. A typical question will be, to what extent? So you need to calculate this price, this break-even price, and also this break-even price. And you tell me that comparing to long straddle, for a long strangle to be profitable, the price needs to be at least, let's just say 48 or something, or 40, 30. So you need to come up with a number very quickly. So actually you can do it from here, 45 plus 4.94, right? You can just do it very quickly. So you can find this is 49.94, and this one is probably 31.06. Something like that. So that's also a very typical question, asking for the break-even points. Okay. And this is about spreads. So again, they capture the different views about the market or the stocks. So you can see that there's a sort of bearish views about the stock. They believe that the price will go down because they can start making money out of it. But it's a sort of conservative because it's a close range in here. And for this one, this is on the other side. So this is about more bullish. So it believes that the price will go up later on. But comparing to a typical long call, it's cheaper, right? You see that it's cheaper. And they are better off until here. So what is this point? Okay, until here, because when the price continues to go up, they start to lose out compared to a long call. Long call is better off. Although it's more expensive, long call is better off when the price goes really high. Okay, so it depends on your belief. And if you believe that the price will go super high, then probably it makes sense. It's worth the costs. Okay, so it's cheaper than the call, but gives the upside potential. Okay, fine. I'm done. Okay. Any questions? Did I miss any questions in the chat box? Okay, let me double check. Okay, fine. Okay, reduce. Okay, fine. Yes. Okay. Okay. A lot of yes. I see a lot of yeses. I don't think I missed any big questions. So, all right. So is that all right? Is that helpful? Okay, great. How about the black screens, people? Is that helpful? It is great. I see. Great to hear. Any question before I let you go? Thank you. Thank you. It's Friday afternoon. Any other questions before I let you go?
Sorry, one last question.
Okay.
Regarding this graph, there's like much more complex trading strategies. So are we expected to like go beyond what is presented in our materials?
What do you mean by that?
Because I have looked into the textbook and other sources, and I found like there's so many like different complex trading strategies with these options, and they have like really complex graphs. Are we expected to like go beyond like our course materials?
Okay. So I think my response would be, I wouldn't ask you to say, you know, what is or what kind of option combination would give a long straddle. I wouldn't give you a question like that because I think that there's so many different combinations that will end up like a straddle position. So no, the typical question is I'm going to give you some different 2 or 3 and most 3 option positions. And then I'll ask you to, combine them and then just show me, probably it would look like something. And then probably I'll ask you, what does it typically called? And then a more relevant question will be, I'll give you probably 2 different strategies or 3 different strategies, and then I'll ask you to compare.
All right, I see. Thank you.
Yes, but the bottom line is that I'm not going to give you very complicated strategies because we need to consider the time.
Yeah.
24-hour exam, probably, but this is a 2-hour timed exam, so it doesn't make sense. Everything should be doable within the 2-hour time frame. So yes, you'll be asked about option portfolio trading strategies, yes, but it should be very, very doable.
All right,
Should be very friendly. It should be very friendly. The idea is really to testing your understanding rather than, again, calculations, trying to.
Exactly.
Again, I think that my questions are very, very sensible in my view. Okay, I'm a very sensible person. So I don't think that you need to worry too much about that.
That's great.
Do we have review slides or notes? I think that you have lecture notes and even my teaching notes. But I'm not going to have a review slide. It's very small. It's a very small unit. So it's just that next week, next Friday, I'm going to say something about Unit 7. And it's likely I'll put my revision slides on Moodle. I think that should be enough.
Hello, Professor. I have a question about the examination. So we need to draw the graph in the exam. So can we draw it by hand and take a picture?
Yes, of course. You can draw it by hand, but please be precise. Use a ruler. Use a ruler or something. And also when you draw, make sure that indicate the x-axis, y-axis very clearly, and maybe the position. And also, by the way, if I ask you precision diagram, give me a precision diagram. If I ask you profit diagram, give me a profit diagram. Okay, just see what the question is asking, and just draw accordingly.
Okay, and then we take a picture of it and then upload it.
Yes, you can take a picture, you can scan it, and do whatever you want, as long as you can see it. We can mark it. Yes.
So does that mean that we can also use iPad to like draw it instead of pen and papers?
Yeah, as long as you can, save it in a format that we can open. You can upload and we can open to Mark. That'll be fine.
All right.
Mhm. Let me see. Upload spreadsheet. Well, again, like I said, my spreadsheet. I don't think it's a secret, but I try not to make it super clear to you. It's in my teaching slides. It's embedded. It's just that I should have removed it, but I accidentally I did it. I forgot. I forgot, and I thought since I already uploaded it so big, it's in my it's together with my teaching slides. Okay, have a look. Can we write some question by hand, but others by typing? Yes, why not? So I remember in the past, in August, I do see students uploading separate documents. So it can be photo together with Word document together with spreadsheets. And but as long as you can number them correctly, saying there's question 3.1, question 3.2, or something like that, that'll be fine. Okay, I think that's all. You're welcome. Any other questions before I let you go? No other questions? Okay. Again, I hope that this is helpful. And again, good to see two faces. You have no idea, okay? Extra time to upload. Yes, I think you are given extra time to upload. If I remember correctly, Greg mentioned that it's twice the amount, not really twice, the same amount of time for writing your exam. So I think it's 2 hours. So probably you're given 2 hours to upload. To me, I think that's really long. It's just that for me, if I were you, I think that it just, I think you should have, but I just, in my view, I think that you have more than 2 hours to write your exam, essentially. So that's good for you. But obviously you need to ensure that your Wi-Fi is okay. You don't want to, finish your exam, suddenly your Wi-Fi, goes wrong or something, and then you couldn't upload or something. So yeah, so overall 4 hours, 2 hours to write your exam, 2 hours to upload, but it depends on how much time. But again, as academics, I couldn't say more, but I can imagine probably you will spend more than 2 hours to write your exam. Probably I would do it. But again, the bottom line is you don't want to spend 4 hours to write your exam or 3.5 hours to write your exam. I think that becomes a bit risky. Okay. All right. Any other questions? All fine? Okay, great. Then I think that's it. Again, I'm so good to see two of you and all other people. And have a nice weekend. And I'm going to see you next Friday. All right. Take care, everyone. Bye. Take care. Hi, Wiku. Bye, Wiku.
Hi, baby. Yeah.
Bye. Take care. Thank you. Bye.